The classic definition of a bear market is a 20% drop in the market. So this has already occurred. The S&P is somewhere around 19.4%. It's almost at that magic 20% level. NASDAQ and the Russell 2000 have dropped over 20% from their high. Now we predicted in August and in September that August particularly, we had something called crash or bear market, was the talk that a bear market would be taking place, and we have now been shown to be correct. The other thing which is important, perhaps even more important, we really don't, 20% is an arbitrary figure, is your bear market trading is when the 50-day moving average is below the 200-day moving average. So the Russell was the first. It happened around September 1, 2007 for the Russell. NASDAQ around January 15th. Now, the cross took place January 15th for the NASDAQ. That was the last one. It had already taken place for the S&P and for the Dow a while ago. So this is a bear market pattern. That cross indicates the bear market. And if you notice, the NASDAQ, this is the price right here. The price is way below the 50. If you get rallies, you're likely to get rallies to the 50-day moving average. That's a logical place for the market to rally to. It can go beyond that. There's nothing magic about that. In the bull market pattern is opposite. You are trading above the 50 usually, and you frequently will sell down to the 50 and then start going back up. This is the stocks are in a bear market. If you look at the charts for gold and silver, they are in a bull market, which we also said. We said that in September that would happen. This is a weekly chart. It's much longer than a daily, not as long as a monthly. The daily, you can look for weeks and weeks ahead, the week for maybe many months ahead, and the month for years ahead, actually. This is an RSI. These are the only three technicals I think you need to look at. RSIs, DMIs, MACD. The under 50 for the RSI means you're in a sell-off pattern. Now this has happened for NASDAQ, it's happened for the S&P. And when it happens on a monthly, a very long-term monthly chart, this means a longer-term sell-off, not a short-term sell-off. In the last sell-off, the NASDAQ got to the 200. It's more likely in this case the S&P will get to the 200. And that could take it down to 1,000 or a little above 1,000. Now it's not going to happen next month. That may happen 2 years from now. We don't know when this is going to happen. Monthly charts are like battleships. They're very hard to turn around. They move really slowly, unlike daily charts which move really, really fast. And once a sell-off pattern begins, it frequently will last for years, months, and sometimes years. And once a bullish pattern starts, it will frequently last for months or years. So once this cross becomes more significant, we really need another month or two. And that sell-off pattern could last 2 more years easily. It's not totally confirmed yet. This sell-off pattern could last 2 years easily. This under 50 RSI could last 2 years. So this could be a very long-term bear market. It could be another mega bear like in 2000. Maybe not as negative. The picture will be slightly different. In 2000, it was the tech stocks that were greatly overbought and in a huge bubble. It's not the tech stocks this time, it's the financial stocks. So you're likely to get the biggest hit on financial stocks and the biggest sell-offs and the ugliest behavior. And they're mostly located in the S&P 500. The change in the monthly charts is what's most disturbing. This does not look good. So you should put your bear market hat on, and you need to think like a bear market trader.